All right, so stocks continued their volatility from yesterday, and again, very Fed related. Yesterday was as Brainerd with the discussion of reducing the balance sheet, and today we saw by how much, about twice as fast as what they did previously that we're accustomed to, which ended up being a pretty volatile 2018. And also keep in mind too that the Fed raised rates in 2018 once a quarter for 25 basis points each, and they're expected to raise rates the next three meetings by 50 basis points each, and then 25 basis points after that at every meeting, not every quarterly meeting. So the pace of rate hikes is much faster. The pace of, in fact, they're probably going to raise rates more this year than they did combined in the last rate hike cycle. And then, of course, their balance sheet reduction, which started, it took a couple of years. It took 4 years before they stopped to the time that they started reducing. That's been shrunk down to a couple of months now this year. And then, of course, they plan to reduce it twice as fast. So have the markets price that in? So that's obviously the big topic. And we'll take a look at that today and what the markets did today and how we're seeing some signs of reversal, a bearish reversal. The question is when. So I'm going to break all that down in today's video. And our trade idea of the day is a stock that's also kind of on its own little reversal pattern after hitting resistance, very similar to the NASDAQ. We'll talk about how to trade that. So let's go ahead and get started. Today is Wednesday, April the 6th, 2022. This is the market outlook from marketscholars.com. My name is David Settle. All right, let's go ahead and get started and take a look at the S&P 500 with the market forecast indicator. And you can see we did break the 23% retracement level after holding it yesterday. We finally broke through it today. This is of the current intermediate run that we're on right now. We did end up holding support here at the 38%, so that's a good sign. The intermediate line still above 80, barely, but still above 80. That's easily in bullish territory, so that's a good sign too. So, obviously things are bearish, but not as bad, right? Obviously we didn't finish at the lows. That kept short-term sentiment not so bad. The near-term line didn't even get in the reversal zone, and the momentum line actually came out of it because of this move off of the low point there. So, and we're still easily above the moving average by almost 2%. Dark green shading the green line, so we're not anywhere near that, though we're that close to light pink shading. We're 0.05 away from light pink shading, but we don't have a yellow line, which means we're getting below the moving average. So, when we're talking about like how bad things can be, this is hardly, there's been a lot more bearish things than that. Well, I mean, there's not dark pink shading in a red line, which is obviously a lot more bearish. The near-term line did form a relatively bearish peak. That's not necessarily the best thing to see that near-term line get only above 50, not even get above 60, and then turn back down. But we'll see if it can stay down, right? Like we might bounce, if we continue today's little rally, late rally into tomorrow and filling in that gap, then obviously that would be a good sign. The NASDAQ 100 looks exactly the same, near-term line a little bit lower. We did dip below that 38, 23% retracement. We held the 38. The NASDAQ's got some really strong support at that 38 because it's the 38% retracement of this little bullish run that we've been on. It's the 38% retracement as a support level now of this decline, this market sentiment decline that ultimately culminated with that cluster. And then it's also the 23% retracement of the post-COVID rally. So there's a lot of Fibonacci support in this case because it's below us. A lot of Fibonacci support right here. So a major support level for the NASDAQ. And the near-term line did form, it did get into bullish territory. So again, that's a pretty bearish near-term peak, even if it's only slightly lower than the last near-term peak there. From where we ended up there, that's pretty bearish. But again, because we rallied off the lows, it ended up being not as bad as what we've seen before. The Russell 2000 did get below its moving average. So we do have light pink shading, yellow line. We are only 1% below, so we're not breaking down. Remember, it's that 2.5% or lower that you're like significantly below the moving average. So we're not that, it's not that bad. But you notice like we broke the 23% retracement. It broke the 38% level yesterday. That's where the S&P and the NASDAQ stopped today, right? And then now we are here, it's starting at the 62%. Like if we continue this little selling the next couple of days, then the Russell is full on like back to bearish mode, like especially if we get back below that 78% retracement. it's back to bearish mode. So, and the short-term sentiment did get down into the reversal zone, so very bearish there. And of course, we are below the 70th percentile, still in bullish territory, but much lower than what we see on the Nasdaq and the S&P. So obviously, things are looking a little bit more bearish for the Russell than what we see in some of these other charts. Regardless of the selling, you can see, again, we got a little bit of a transition candle, so an upper shadow and a lower shadow. We'll see what ultimately it looks like by the time all is said and done here. We're most likely not going to close above the last week's high point. The differential is still positive, and you're still rising your PPO. So it's not, we're not that bearish here. The Nasdaq did get a red arrow, long upper shadow, lower shadow, but we still don't have a negative differential. We still don't have the falling PPO. We do on the Russell, right? The Russell got a red arrow again, which we're already in death cross environment, so it's got a new red arrow on the 10-week moving average. The PPO is falling and the differential is negative, and we have both an upper and a lower shadow there too. So you can kind of see how bearish things are. Again, more bearish even there than on the Russell. So no more light green shading on any of these. In fact, we have pink shading on the Russell. So again, if we can bounce back up tomorrow, because when we're bullish, you should only get a day or two of pink shading. Just like when you're bearish, you should only get a day or two. Like, let me zoom out and show you if I can go back to another bullish period. When we're bullish here, and we didn't really get light pink shading during that period, but you can see we had a little bit there for a few days, and that was it. Let me see if I can find another good. We didn't get light pink shading there or there. Over here, we got light pink shading. We came really close there and turned right back up. We got light pink shading there, turned back up. A day there, turned back up. That's typical. Just like during a bearish move, having brief periods of green shading is very typical too. So here we are now with 1 day of pink shading. That should be it, right? A 3 red arrow signal is actually, when you're bullish, is actually a really good buy signal. So this should be a buy signal. We should bounce off of this tomorrow. If we don't, and we continue through today's low, then we know that it's going to be more that we're changing the trend, especially with a decent amount of volume there. When you look at the averages here, this kind of tells us an interesting story too. So the MACD has just turned below its moving average. We are below the 17-day and the 200-day on the S&P. So we are starting what may be a bearish divergence on here. A lot of stocks did too. The Qs hit the 200-day and the point of control for this past year for a resistance level, and also we're back below the 17-day moving average with the MACD cross there. And then IWM, same thing. We are well below the 17-day, so we are in full-on bearish mode, and the MACD is still actually positive, below its moving average, but still positive. I showed this to our class yesterday. The stochastics indicator, this is the 20-day when the stochastics, when we drop below the average, that's a little bit of a bearish crossover, especially when that cross occurs below the 80th percentile, not above it. You get above it, it's not that big of a deal. Getting below it, kind of like we did over here, there's a little bit more of a bigger deal. So it's a little bit more bearish from that perspective. The Nasdaq, you see the same cross, and we got the crossover yesterday, was why we brought it up on the Russell. And now the Russell is actually in the lower half of its range, of its 4-week range. So you can see how significant that is for the S&P and the Nasdaq and the Russell to be below that 20-day moving average of the 20-day stochastics, of today's stochastic relative to the 20-day range. And I also showed you too that on the Russell, I even tweeted this out, that we got the bearish reversal on the whole yesterday. Right here, we closed below the prior day's low. The parabolic SAR flipped to the upside. The whole turned red the day before, and we had the bearish candle. Well, that happened today for the SPX, right? So SPX, if I can type it in correctly. There we go. That happened today here. So we did close below. We flipped the parabolic SAR to the upside, and then the red line. So, and then you can see we are. In fact, the other thing I did here is I changed this PPO down here to the 200-day. So where are we right now? The green line is where are we relative to the 200-day haul, and then the purple line is the moving average, the 9-day moving average of the haul. And you can see crossing below that is also relatively bearish. So especially when you're already red on the 200-day. Over here we actually had a green line, so we're already red here, and you can see over here same thing happened when we flipped to the downside multiple times. So we're getting that crossover now. This is a relatively bearish crossover for the SPX that you see too, that we have on the Russell, and then you can also see too on the NASDAQ. Very significant change in direction here and a bearish crossover on these indicators. Not quite as bearish on some of these others. We are back above 25 on the negative indicator, though we're not below 20. But getting above 25 is, that's not necessarily the best sign. With the negative index, this one we almost dropped below 20. On the IWM, we are at 20.01, but that's a bearish crossover there. And then the Qs, again, we're above 25. Even if we're not quite below 20 yet on the positives. So you can see how things are kind of shifting here. The RSI, we are back below 60, but not below 50 yet. We are below 0 on the CCI. The Russell 2000 got a really bearish signal, so we're easily below 50, and then we busted down to minus 200. That's the most bearish we've seen in quite a while. I mean, we saw that over here in August when we weren't really bearish yet. So that's a real significant drop. The NASDAQ, you can see, not quite below 50 yet, but not by a lot at least, and then not barely below 0, so not below that minus 100. See SPX, we're not below that minus 100 yet either. So we're not really in bearish territory yet, but you can see how we're headed in that direction. The Ichimoku cloud, we're still above the cloud on SPY. Back into a pretty wide cloud on the Q, so we've got a lot of range to work with. And same thing in IWM. Again, we had the beginnings of a bullish trend. That's gone on IWM. SPY had a bullish trend going too. It's still there, right? It's still got a intermediate trend strength on SPY, and the Q, same thing. Not quite. We're not above 2 anymore, but you can see we're not noisy. We haven't hit 0 on either of those indicators. You also see that too in the Arun. This is very similar to that stochastics that I showed you earlier. We haven't crossed over yet. Like the low point hasn't broken up to the upside, which can happen when you're at the beginning of these bearish moves. We haven't had that yet. We haven't had that on the Qs. We haven't had that on SPY, and we haven't had that yet on the Q. I mean, it would take quite a bit for us to get a new 4-week low point. Like SPY, we're still in the upper half of the chart. QQQ, we're still in the upper half of the chart. IWM, we are in the lower half of the chart, but we're not anywhere near a 4-week low yet, and it's still going to be a few days before the 4-week low starts to move up a little bit. But you can also see too, there's not a lot of volume holding us down. Now, there's not a lot of volume to get back up to 205 either. We could jump up 5 points really quickly tomorrow. I would not be surprised if we got a little snap back, something like that, not going all the way up, but getting up to resistance. But again, like to show you how tenuous that is, we could drop to 190 just as easily. We can jump up to 205. There's just no volume there, because we went down and up so fast. There was no volume that kind of stuck there compared to what we've seen up above that. When you look at today's volume and trading range, you see that we were 106 million. The range was 5.5 points, but keep in mind the gap there. So, and it was a relatively significant gap when you look at. We were more than 1 standard deviation to the downside. So when you look at that range and volume, so we were at what 5.5 points, but we closed there at 451. The high was 449, so 2 points. So you are right about the average, and we were right about the average on the volume as well. Well above the 1% mark, the 5 some odd points, being well above 1%, and kind of turned it up actually. And then the volume you can see was a little bit above that average too, so at 100 million. So you can, things are, those are bigger numbers. And if we get more days like that, And then we talked about how we were getting such small ranges and volumes for a market that really hadn't bounced yet. Here's the other thing that's kind of significant too, in my opinion. So volatility, like as bearish as we were, volatility finished the day at 85%. We finished the day lower in volatility than where we opened on that. So this is what it looks like on this chart, right? Big long upper shadow. That's not necessarily the best sign, because you can see when you get, sometimes you can come right back down, but you can see back over here at the beginning of the year when we got, it looked like we were going to go up, and then we came back down by the end of the day, very similar to this. We stayed within the range for a couple of days, and then we moved up, and that was the last time, if you recall there at the beginning of the year, whoops, that was the last time that the VIX had such a small, I mean it wasn't nearly as low as what the VIX, the MACD wasn't as low as it is now, but that was the last time it was relatively low. We were below the 200-day moving average. We jumped up, we got this long upper shadow, right there on the 10th. That's what the candle looked like there on the 10th. We came down a couple more days, and then boom. So heading into expiration, that last week of expiration, we took off, and then after expiration. So can we get something like that again with the MACD barely turning up and getting right around that 17-day moving average? Definitely a possibility. So that's why again. Can we get a snapback? Yes. We snap back by the end of the day today. I think there's a good chance that we can snap back up on the markets tomorrow and maybe even Friday, slowly Friday. But you can tell that the bears are there, right? When you poke the bear's waking up. The bears are willing to participate in the markets. As bullish as it seemed like we were the last couple of weeks, we weren't bullish enough to eradicate the bearish sentiment that's out there. It was just dormant for a couple of weeks while the bulls kind of had a little bit of a heyday, and the last 2 days kind of showed from a technical perspective that we weren't as bullish as we thought we were, and that's what we have been talking about, and it shows just how bearish we can be, right? How much sentiment is pent up and potentially unleashed. So will it unleash? Are we just, is the bear loose? I don't think so. I still think, especially going into expiration, I think we'll kind of be choppy up and down. I think it will be after expiration, after April expiration. That's it seems like that's kind of what the charts are kind of telling us too, that we kind of poked it a little bit, but now expect a little snapback heading into the end of this week. Next week is expiration week. It'll probably be a little flat. We'll start have the earnings, right, and then after expiration, as the earnings kicks into gear, we have that first meeting at the beginning of May. I think that's when volatility will really start to pick up again. And this will really take back off up to the high 20s and low 30s and potentially and bring the markets back down to where we had been earlier before that March low point. So what do you think? Do you agree with that? Do you disagree? Let me know in the comment section below, especially if you disagree. What charts or indicators are you looking at that suggests why you're either a lot more bullish than I am or a lot more bearish than I am? All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us two things. One, you liked the video today. And two, you want us to do another video again tomorrow. It's a quick way to give us feedback if you like our stuff. Of course, if you don't like it, you don't have to click on anything. You don't even have to watch if you don't want to. Also, comment down there. What did you get out of the video today? What stood out to you? What questions or comments do you have? Post those in the comment section. Join our website at marketscholars.com. There's a link popping out up there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content between the videos. There's my handle, @DavidSettle42. And join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things over here on the right. Click on this icon, the Market Outlook Live. That takes you to this page. On Monday, Wednesday, and Fridays at 3:30 Eastern Time, I do a quick little 10-15 minute video. We take a look at all the trades we've done in prior market outlooks to see whether we should stay in them. We actually closed a couple today from prior videos. We also put on today's trade idea already before the market closed. So you can see that trade there, and you can also see all of our archives listed there as well. You can get to it by clicking on Market Outlook Live Trade Review in our main menu. Come down here, click on this View More icon. You can see our upcoming classes with a full calendar of upcoming classes here, as well as 4 years worth of recordings going back to 4 years to March of 2018 actually. Come down here to the bottom, click on that heart. It opens up that tab. Hit that like button. Also click on this tab, thumbs up. Click on that like button there. Again, the more you do that, it gets our content out to more of our followers. It helps us get our reach out because of all the engagements these posts have. That's why we always ask. It helps you too because Twitter and Facebook promote content in your timelines from the accounts that you engage with the most. We try to make it really easy for you to engage with us right here. All right, now let's take a look at what's driving this price action. You can see this is the last 2 days. Obviously, the Qs and small caps, both mega caps and small caps, are essentially moving together, and U.S. stocks in general. Now, you also have developed and emerging markets dropping. Look at long-term bonds. Look at the big drop that they had. They're right down there with these really aggressive, higher beta asset classes, equity asset classes. Whereas on the other end of the spectrum, dollar and gold are both the best performers along with real estate here. Again, hard assets, that's the kind of, except for the dollar, of course, but real estate and gold, hard assets, physical assets, the dollar being the safe haven currency. If you take a look at the euro US dollar and the move that it made, it was trying to make this really strong bullish move. It has since failed making that bullish move, and now you can see potentially forming a double bottom. We'll kind of see how it does here. Obviously, it's a much higher MACD low point than what you got there. Long-term bonds really dropped down and gapped down again, and we saw a gap over here, near the end of that MACD decline. Now the question is, we're already to lower low. Are we setting up here for a bearish or bullish divergence? Excuse me. With the MACD, with long-term bonds hitting a lower low than what I had there. If I were to go out a little bit further in time, so you can see the retracement of this big long-term move. It appears that we're headed towards this 125 area, which is where that 78% retracement of that big long-term run that we've been on. If you go to the 5-year weekly chart on this, well below the 200 weeks. So bonds are in a bear market, right? The bonds had a correction during the post-COVID rally. Bonds had a correction. Then they had a pretty decent 2021 for the good chunk of it, and then have been in bear market mode. So back in correction at the beginning of this year, and then now in bear market mode. But like I said, pretty strong support here at 125. A lot of volume support. As well as the Fibonacci retracement level, because then at that point you break below 121, that point of control. Then this is the 5-year point of control, mind you. Then it's really looking pretty poor for long-term bonds. You can see from a linear regression standpoint, bonds are down below 2 standard deviations on a 1-year basis. If you look at it on a 5-year chart, we are close to the 2 standard deviations on the 5-year chart. And then finally the longer term view here, 10-year chart, you can see we're actually only down to the 1st standard deviation level. But that's again, that's a pretty low level to get down to 1 standard deviation below the median, where the median right now is at 147. Of course, if there's any big change in risk appetite, that's really going to move that up. You can see the ATR is really high. When you look at the directional movement index for long-term bonds, you can see that the negative indicator again is ramping up to a really, really high level. The positive is almost back down below 15. That's on the daily chart. Looking at the weekly DMI, we're not quite as bearish as we were over here when we had that bearish run. We were green. When the positive got up above here, we were green just because the ADX was still falling. Here the ADX is actually still below 25. It's above 20, but still below 25, so we don't have that dark pink shading yet, which is what happens when it gets there. And you can see the big, long, bullish run that we had during this bear market, right, that we had where bonds were really bullish in the fall of 2018 all the way through the COVID low point in equities, and then a little bit beyond that is ultimately where it peaked in late July of 2020. You can see the nice strong run going out a little bit further, just to kind of give you a sense of this bearishness that we had in bonds in 2020, 2021. If you take a look, going over to the left, I mean, 2006, you had a little bit of a bullish move, but outside of that, I mean, that's really it. I mean, that on a weekly basis, the DMI, it's rare for the negative DMI indicator to get as high as it did. We had it there in 2016, post the election. In 2016, coming right after the election there, and you see how it stalled out, and the same thing on some of these others. If I were to go to the weekly chart again, just kind of to compare that MACD down there on TLT, again in the last 20 years, this is it's in the lower 10th percentile. There's been a few other moves that have been lower, like again this drop. The drop in 16, the drop in 2013 with the QE that really put pressure on it, and then the post low point that we had in 2009 low point, we had a big drop. So needless to say, this is a big drop again, one of the bigger ones we've had, and it's actually a higher low point comparatively speaking to where we're at. So you can see all these other instances, it was relatively bullish for bonds. So, especially coming off of divergence where you would target, in this case, you'd probably target the 38% retracement there, 150, as a target for the divergence. If and when we do get back up again, you have to, for the MACD to peak, the histogram's got to peak. And you can see it kind of did there, but we kept going down. So now you need the histogram to peak again. That usually peaks first, and then the actual MACD does. And you can see it takes, when you get a red dot, you tend to get a few of them. You can see a few of them there, a few of them here. So we're probably still a few dots away from getting our low point. This is the start of it, but it appears it'll probably be a process around this 78% retracement. And again, keep in mind that post-April expiration, if we are going to get a bout of volatility, more than likely would be bullish for long-term bonds, not necessarily bearish, as the market shifts away from this risk appetite that it's been having, and the association with bearishness with higher yields, right? Because again, that inverted yield curve, the yields are doing great. It's a nice, good move to the upside. We'd have to probably break this 2.66 level to really kind of take off past that 78% retracement, and now be bullish in the long term. It's a great move to get above the 200-week moving average there. We haven't had very big moves like that, and the MACD is pretty high, relatively high. Again, that's a post-COVID rally in yields. But outside of that, you can see, and this is a PPO, so you can see this run was similar in terms of the PPO, and you notice that it kind of stalled. It got above the 200, just like we are now, and it just kind of stalled and came back to the 200. And same thing actually over here, and we ended up stalling after a move higher there in yields. And you wonder if we're going to end up stalling here again for the exact same reasons. Again, not until the histogram's got to peak first, and then when the histogram peaks, you look for the actual MACD to peak, and then that will usually start to limit the upside once that happens. Let's take a quick look at how the sectors are moving here. And again, let's look at the last couple of days, and you can see, what's been driving a lot of this risk aversion is XLK, XLY, XLC. They've been the ones that are up the most. They were the ones that were down the most before the March 14th low point, coming off that January peak. So they're just, if I were to go all the way back to when all this really started to go downhill for equities here in the U.S., it was on that July 4th time frame. Let me change that to like a 30-minute chart. And you notice that's, from July 4th, that's the peak down to the March 14th low point. We rallied off of that. We're down. We're still, as volatile as these sectors have been, they're still down 12 to 14%, about double the broad market, and everything else is kind of flat, with utilities still doing very, very well, up 8.5%, with a lot of those gains coming here just recently. And then, of course, energy had such a great run that's been consolidating pretty much since that since early March there for the past month. All right, now let's take a look at our trade idea of the day. I want to take a look at Lululemon, which at one point in time got to 20% up above its 30-day moving average. That's a pretty significant move to the upside, well up above there. And you notice the intermediate line got higher. You also notice that the near-term line got up there, but it potentially is forming a pretty significant bearish divergence. Much lower high point after a dip below 50, but not in the bearish territory. And then again, only really 1 day above 80. So relatively bearish near-term peak, even though it was a much higher peak. It was a really good kind of post-earnings run there. When you look at some of the other charts, like if you look at its weekly chart here, we see very similar things. I mean, it's a great bullish candle, green arrow, rising PPO, about as big of a candle, positive candle as we've seen in the last year at least. You know, we can go back over here to when we had these bullish candles, we kind of went sideways there. But the difference here is back over here, we were closing above the previous week's highs. Here, we're not. We are not closing above the previous week's highs, nor do we expect that we will. Like that high point's 384. You know, the high point, last week's 384. We're trading at 371 right now. When you look at some of these other oscillators here, take a look here at the MACD and stochastics, and you see kind of why we stopped where we stopped. We hit right up against the 200-day moving average there, and you notice we are kind of hitting the 8-day. The MACD histogram's already peaked. The MACD looks like it's peaking at a really, really high level, mind you. Again, you have to go back quite a bit, like 5 years. You have to go back to the post-COVID rally to be anything more bigger than what we had here. And really it's kind of very similar to that one that we had back in early 2018 when we jumped up after an earnings. And then we didn't go anywhere for a few months, and especially by the end of 2018, we were really stuck. When you look at the, this kind of correction that we've had going on, this again, the rally got up to the 200-day moving average. Well, it also got up to the 30 week falling moving averages with that long upper shadow last week, a much smaller range this week, looking like it's kind of petering out with that strength and forming a top there. Looking at the DMI for Lululemon, you can see, we got above 40 on the positive. I mean, that's a pretty good move to the upside. When you look at the RSI and the CCI, they're also showing really strong peaks. We got above positive 200, we got above 70. Looking at the trend strength indicators for Lulu, you can see we got above the cloud, and you've got a mature strength bullish trend going on. You're looking at the Bollinger bandwidth. The bandwidth is at a really, really high level, higher than we've seen in quite some time. Again, you have to go back a few years, back to that post-COVID rally. Well, that was a COVID drop that got that high, but then this drop here in 2020, as well as that post-COVID rally, are other instances where the bandwidth got higher than where we're at right now. So really good move to the upside. It's really pushed the bandwidth up. We are already back out of the upper quartile, and you also see too we are back towards the Keltner channels. So when I load up the style so we can see the Keltner channels with this, big gap between the Bollinger Bands and the Keltner channels. That momentum really strong, but again, not in the upper quartile anymore. Would suggest that we're going to, at the very least, start consolidating right now. So what we decided to do here, since we don't have a whole lot of downside potential, but it seems to be that there's some resistance in this area, then we decided, okay, well, let's do a bear call spread, selling the 390, buying the 400. We ended up getting, 320 out of it. So a lot less, for about a normal reward, we took a lot less than normal risk. Because normally we put $1,000 at risk on these trades, and we're getting 600. We're only putting 680 at risk here. And again, we don't have to worry about the earnings. So it's a really good reward to risk ratio, considering the amount of risk we're actually putting onto this trade. All right, well, that does it for today. You've heard from me now, and I want to hear from you. Use that link that's popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos As always, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video down below. Also, subscribe to our website at marketscholars.com, like us on Twitter and Facebook. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.